Most people retire at 62 for one reason, and it has absolutely nothing to do with whether they can actually afford to stop working. It is simply the earliest age that Social Security happens to kick in, and that single arbitrary number is quietly stealing 7 of your best years and costing high earners hundreds of thousands of dollars in lost tax planning opportunities that they will never get back. After sitting across the table from clients who walked away at 55 with more after-tax wealth at age 80 than the ones who grinded it out all the way until 62, I have seen exactly why the conventional retirement age is nothing more than a trap, and why 55, when planned correctly, wins on lifestyle and health and money at the same time. In this video, I am going to show you the 6 reasons retiring at 55 beats 62 every single time. How to bridge the income gap all the way to 59.5 without paying a single dollar in penalties. And the 3-phase framework that turns early retirement from something that sounds like a fantasy into a concrete plan you can actually execute. I am Sally. Welcome to Sally Krawcheck Retires. If this is your first time here, please subscribe right now and hit that bell icon so you never miss a video, because what we talk about on this channel is the kind of information that can save you 6 figures or more before you ever leave your desk. Okay, now let us get into it. 62 is the default retirement age for tens of millions of Americans, and the reason behind it has absolutely nothing to do with financial optimization. It has nothing to do with when your portfolio is ready or when you have crossed some magical finish line. It is simply the earliest age that you can claim Social Security benefits. That is it. That is the entire reason. And basing the single most important lifestyle decision of your entire life on the eligibility date of a government program is nothing short of letting the tail wag the dog completely. What gets completely lost inside that default decision is the window from age 55 to 61. And for high achievers, this is a window that does not come back once it is gone. Your kids are grown. Your mortgage is mostly paid down. Your net worth is substantial and still growing. And critically, your physical capability and your energy are still at their absolute peak. Gerontologists who study aging describe retirement in 3 very specific phases. They call them the go-go years and the slow-go years and the no-go years. And the years between 55 and 65 are sitting right in the heart of your prime go-go window. Waiting until 62 means you are trading 7 of those irreplaceable go-go years for a paycheck. And you end up with excess money sitting in accounts in your 70s and 80s when you may no longer have the health or even the desire or the energy to spend it the way you always imagined. That is the bizarre paradox sitting right at the center of conventional retirement timing that nobody is talking about. And the costs of working until 62 are not just about lost time either. 7 more years inside a high-stress career produces very real and very tangible medical costs that frequently exceed the financial benefit of that additional salary. You simply cannot buy back missed anniversaries. You cannot buy back the trips with aging parents that you kept saying you would take next year. You cannot buy back being the grandparent who can actually get down on the floor and build the Lego castle with your grandkids and then get back up without needing help. The deeper truth that most retirees only discover after they have finally pulled the trigger is this: they needed less money and more time than conventional planning ever suggested to them. The standard retirement model is built entirely on rules of thumb, like you need 80% of your pre-retirement income or you need $3 million. Numbers that are specifically designed to keep you running on the accumulation treadmill forever, not to tell you when you are actually ready to retire. So yes, 62 is an arbitrary number that is quietly wasting your very best years. But how do you actually know whether 55 will work for your situation? And that starts with flipping the entire planning model completely on its head. The fundamental problem with 99% of retirement planning is that it starts with a terrifying abstract savings goal: 3 million, 5 million, whatever the online calculator spits out at you, and then it works backwards from there. That approach keeps you feeling permanently behind no matter how much you have actually saved. Lifestyle reverse mapping flips that model entirely. Instead of starting with a savings target, you start with the only thing that genuinely matters, which is your desired retirement lifestyle. And then you work backwards from that to get your real number. Here are the 3 steps. Step 1 is what I call the blueprint. You do not talk about money yet at all. You talk about your actual life. Where do you want to live? What do you want to do with your weeks? Where do you want to travel? Would you like a golf membership or a boat or a second home somewhere warm? You build a detailed and vivid and honest picture of the actual retirement that you personally want to live. Step 2 is the price tag. You attach real current day costs to that vision. You look up what a golf membership actually costs at the club you want to join. You research flights and hotels for the trips you have been dreaming about. You build a real line item budget grounded in actual data, not guesswork or fear. Step 3 is what I call the expense purge. You subtract every single cost that is tied to your career: commuting costs, business lunches, dry cleaning, your professional wardrobe, parking, the second car you only own because both of you need to commute every day, the coffee, the conference fees, the professional dues. For high net worth professionals, that list alone adds up to $2,000 to $5,000 every single month, which means your actual retirement costs are typically 20 to 30% lower than everything you have been assuming this entire time. And here is why this matters so much. Traditional retirement planning inflates your needs and quietly feeds what advisors call the one more year syndrome, where no number ever feels big enough to actually quit. Reverse mapping does the exact opposite. It gives you clarity and a real finish line you can actually see and aim for. Let me give you a real example. A client of mine was spending $120,000 a year while working, but when she sat down and did this exercise, she discovered her actual retirement lifestyle was going to cost her $85,000 once all those career expenses disappeared. That $35,000 gap completely changed her savings target overnight. It shifted retirement from 10 years away to I might actually be ready right now. So reverse mapping shows you the real number. But the biggest objection I hear constantly is always the same. My money is locked inside retirement accounts and I cannot touch it until I am 59 and a half. And here is why that belief is simply not accurate. This is the number one question I get from every single person on this channel. My portfolio is large enough, but it is all sitting inside my IRA or my 401k. How do I actually get the money out for 7 years without getting absolutely crushed by early withdrawal penalties? And the answer is a combination of 3 specific tools that, when sequenced correctly, create a completely seamless and completely penalty-free income bridge from 55 all the way to 62. The first tool is your taxable investment account. This is a standard brokerage account that was funded with after-tax dollars, and it has 0 age restrictions attached to it. You sell assets and use the cash immediately, and you only pay capital gains taxes on the gains. And if you have held your positions long-term and your taxable income is kept low, some of those gains can actually be harvested at the 0% capital gains bracket. For most early retirees, this is going to be your primary funding source for those first several years. The second tool is something called the Rule of 55, and most people have never even heard of it. If you leave your employer in the calendar year that you turn 55 or any year after that, you can take completely penalty-free withdrawals from that specific 401k plan. Not all of your 401ks, just the one that is tied to the employer you separated from. And this has to be planned for in advance, including making absolutely sure that you do not roll that 401k into an IRA before you tap it, because that rollover will permanently destroy your eligibility for the Rule of 55. The third tool is what is called a 72T, which stands for Substantially Equal Periodic Payments. This allows you to take a calculated series of penalty-free distributions directly from your IRA before you reach 59 and a half. The calculation has to be precise, and the payments have to continue for at least 5 years, or until you reach 59 and a half, whichever period is longer. When you layer these 3 tools together, the 7-year gap from age 55 to 62 stops being a barrier and becomes a genuine planning opportunity. And that opportunity becomes even more powerful when you stack Roth conversions right on top of it. In those early retirement years, your taxable income is often the lowest it will ever be in your entire life. There is no salary coming in, no Social Security yet, no required minimum distributions forcing money out of your accounts. That creates what financial advisors call a golden conversion window to move money from your traditional IRA into a Roth IRA at dramatically lower tax rates than you will ever see again. You pay tax right now at, say, 10 to 22% instead of 24 to 32% on those exact same dollars when you are eventually forced to pull them out through required minimum distributions later on. Someone who retires at 55 has a full 20 years before their RMDs begin. That means they can convert $50,000 to $80,000 per year at those low rates and potentially move $800,000 to $1 million or more into a completely tax-free Roth account before forced withdrawals even enter the picture. The person who waits and retires at 62 only has 13 years before RMDs begin, and Social Security starts filling up their tax brackets within 3 to 5 years of retirement, which means the Roth conversion window for them is much shorter and far more crowded and significantly more expensive per dollar converted. Now that you understand how to bridge the income gap, I want to talk about something that surprises almost everyone. The health argument for retiring at 55 is actually stronger than the financial argument. Life expectancy in the United States right now is roughly 79 years, but the years you can genuinely count on being physically healthy and active are far fewer than that number suggests. For someone who reaches the age of 60, the data shows approximately 15 more years of genuinely healthy living on average, which means health typically starts declining somewhere in the mid-70s, with additional years of life after that often lived with declining health conditions and reduced capability. So if you retire at 62, you are looking at roughly 13 healthy years remaining. If you retire at 55, you get 20 healthy years. That is not a small difference. That is a 50% increase in the actual time you have to enjoy the wealth you spent your entire career building, and no amount of additional savings in the world can ever buy those years back for you once they are gone. Research shows that 46% of employees say that most of their daily stress comes directly from work, and 77% say that their work is negatively affecting their mental health in significant ways. Chronic workplace stress in your late 50s does not just feel bad in the moment. It actually accelerates the biological aging process and creates physical and mental health problems that will absolutely follow you right into retirement and cost you money for the rest of your life. The retirees who left their stressful careers at 55 almost all report the same pattern in those first couple of years after leaving: dramatically improved sleep, lower blood pressure, better mental health, fewer medical appointments, and lower prescription costs. The deep irony here is that most people keep grinding at work specifically so they can afford health care. But the work itself is creating the health conditions that make health care more expensive in the first place. But here's the part that is going to surprise you the most. When done correctly, retiring at 55 can actually make you wealthier in the long run than staying until 62. The common belief is that retiring early is a financial sacrifice you make in exchange for a better lifestyle. But what if it is actually the other way around? With the right levers pulled in the right sequence, retiring at 55 can lead to genuinely better long-term wealth outcomes than continuing to work for 7 more years. The first lever is tax arbitrage, and it is the most powerful one on the list. The years between 55 and 75 are essentially a tax paradise for the person who plans correctly. You have nearly total control over your taxable income. No mandatory salary forcing you into a bracket you did not choose. No forced RMDs. No Social Security income yet if you have delayed claiming it. This means you can execute strategic Roth conversions at the lowest possible rates. You can harvest capital gains inside the 0% bracket. And you can manage your withdrawals year by year to stay in the most favorable tax position possible every single year. The person who waits until 62 squanders those golden years with a salary that fills their tax brackets and blocks all of these moves completely. The second lever is geographic arbitrage, and it is one that most people completely overlook. When you are working, you are physically tied to a location whether you like it or not. The day you retire, you are completely free. For someone living in California or New York or Illinois, relocating to a state with no income tax is the financial equivalent of a permanent 10% raise on every single dollar of investment income for the rest of your life. That one move alone can be more financially powerful than 5 additional years of salary. The third lever is what I call the time dividend. You now have 40 to 50 hours every single week handed back to you. That time can be redirected toward becoming a more intentional consumer who makes significantly better financial decisions across every area of life. Early retirees consistently optimize their spending more effectively than people who are still working, not because they have less money, but because they finally have the mental bandwidth and the time to actually pay attention. When you stack all 3 of these levers together, the result is often a higher after-tax wealth trajectory at age 80 than if you had simply ground it out until 62. A retiree who leaves at 55 and converts at the 12% tax rate for 18 years and relocates to a zero-income tax state and uses their free time to optimize their spending can end up with $200,000 to $500,000 more in after-tax wealth at age 80 than someone who worked until 62. And that is before you add in the bonus categories. ACA marketplace subsidies during the 10-year gap from 55 to 65 can save another $80,000 to $150,000 in health insurance costs alone. Carefully managing your income during those years before Medicare also keeps you below the IRMAA threshold, which is the Medicare premium surcharge that hits higher earners, and that saves another $40,000 to $100,000 over time. Add it all up, and the picture completely inverts. The person who retires at 55 is not sacrificing wealth for a better lifestyle. They are getting both at the same time. Now, here's the one action I want you to take this week. Not a framework, not a worksheet, one single action. Pull your last 6 months of credit card and bank statements and go through them and highlight every single expense that exists only because of your job. Commuting costs, parking, lunches out, dry cleaning, work clothes, the second car you only have because both of you need to commute every day, the coffee, the professional dues, the conference fees. Add every one of those highlighted amounts together and multiply the total by 12. That number is the money you stop spending permanently the day you walk out the door for the last time. For most high earners I work with, that number lands somewhere between $20,000 and $40,000 per year. That is the real gap between what your retirement actually costs and what every single retirement calculator on the internet is going to tell you that it costs. If that number surprises you, then you now have clear evidence that the standard financial model has been quietly lying to you for years. And 55 may already be on the table for you right now. The 62 default is not based on financial optimization of any kind. It is based purely on when a government program happens to start. Lifestyle reverse mapping reveals that your real retirement costs are typically 20 to 30% lower than everything you have been assuming. The rule of 55 and 72T withdrawals and your taxable brokerage account and Roth conversions can all bridge the income gap without a single dollar in penalties. Retiring at 55 gives you 20 genuinely healthy and active years instead of 13. That is a 50% increase in the time you actually get to enjoy every dollar you built. You do not have to let an arbitrary government number dictate what happens to the best years of your life. You already have more options than you think. If this video helped you see your retirement differently, please give it a thumbs up right now and share it with one person who needs to hear this because it might completely change the trajectory of their retirement. And if you are not subscribed yet, hit that subscribe button and ring that bell icon right now so you never miss a video. I am Sally, and this is Sally Krawcheck Retires, and I will see you in the very next one.